What up? What up? What up? What up? Episode 3. We in this thing. Welcome back. I haven't named the podcast yet, so just welcome back. We chilling. What we're gonna talk about today is really just we're gonna talk about 5 things I was super embarrassed and or bored about when I learned about investing. Cause when I learned about this stuff at first, I was like, this is far too much. This is boring. This is stupid. Why do I have to know all this just to be able to invest any kind of money? I always thought that was weird. So we're just going to jump right in. You know me, I like to make things super simple. I like to make them super understandable. So yeah, we'll go from the beginning. So, and I'm gonna make sure I explain this stuff like it's just me and you. We just chat. So, first thing that you're gonna notice on all, like when you're reading different Barron's articles, or you're reading the Wall Street Journal, or you're really anything that's like has to do with the stock or with the company, you're gonna hear what's called the PE ratio, and PE ratio is a price to earnings ratio. That sounds boring. Sounds weird, but when I first heard it, I thought it was this mathematical equation that they take the price of the stock and how much money they earn and this, that. No. What it actually is how much you are paying for every dollar that the company earns. So, a good example that I have is if a stock is $50 and the PE is 25, you're paying $25 for every $1 they earn per year. Is that expensive or is it cheap? It really depends on the industry. I'm very into tech companies. So tech companies often have higher P to E ratios than others. And like a bank in particular, they usually have lower P to E. Not very important, but here's why you care about it. It helps you know if a stock is overpriced or underpriced compared to similar companies. So if a tech stock has a really high P to E, and you notice it's much higher than all the other tech companies that you're looking at, well, that stock might be overpriced, but it could also be underpriced if their P to E is lower than the vice versa. Now, this isn't just something you go off of as like, oh, it has good P to E, it has high P to E, so I think I'm gonna buy it. Like, no, these are one of the things that you add into your arsenal of what you look at when you're researching a company. So yeah. Number 2 is market cap. You're gonna hear this a lot. You're gonna hear market cap, you're gonna hear CapEx, you're gonna hear all these different terminologies, but we're gonna keep it simple. So when I first thought of market cap, I thought it was like the limit that the market can make money in. I was just like, well, when I heard that, I said, okay, well, whatever. But what it actually means is the total value of the entire company. This is the stock price times the number of shares. So a good example would be Nvidia is worth $4 trillion. It's the first $4 trillion company ever. Just a fun fact. But that means that the stock price times the number of shares that Nvidia has out is equal to $4 trillion. It's really like 4.86 trillion now, but it's going up. And so you'll hear that a lot, especially with these major tech companies and just really any company that you're studying. Anytime you read anything on the stock market, you're going to hear this company's market cap is such and such. Or when you hear that this company crossed the $3 trillion market cap, the $3 trillion cap milestone. Like, yeah, that's what they're talking about. It's really simple. It's not crazy. But another good example is Apple has a market cap of $3 trillion. That means that if you wanted to buy the entire company, you need $3 trillion. A small cap company, like a smaller company, might be around like 500 million. But yeah, last thing, why do you care about this? It tells you the size of the company. I mean, of course, when you hear bigger companies are always better because, I mean, when companies have big amount or worth a lot of money, that's very telling. Nvidia for sure. It's like Nvidia is a $4 trillion company. Very telling. They didn't get to that number out of nowhere. They didn't do that out of any, they didn't do that by accident. So more to look at when that is better. But the bigger a market cap is, the more risky it is. Nvidia is another good example. I talk about Nvidia a lot because it's just the world leader for AI and one of the companies I watch very closely. But when companies are so big like that, good is not good enough. So like Nvidia beat earnings. They beat Wall Street's expectations recently, actually. And the stock went up, but shortly after the next day, it was back to negative. And the thing is, the entire stock market is watching Nvidia. So when Nvidia doesn't beat expectations, or when they don't meet expectations, or they're not simply just not as high, like when expectations are not met as highly as anticipated, then that has an effect on the entire stock market. So Nvidia can say, oh yeah, we lost business in China. And every tech stock is affected by it because now everybody's like, I don't know about Nvidia, and I don't know about this AI sector. I don't know everything about it. And that's actually what's going on now. There's a lot of speculation in the AI world that we're in a bubble and it's going to pop, and we don't know why these companies are spending all these billions of dollars. Is it really worth it so much? And it's just it's a good example of when you're so big, a lot of other things ride on your shoulders because it's just because it can be dangerous. So bigger isn't always necessarily better, but the bigger a company is, the more effect it has on the stock market, but it is also riskier. So just something to look into. It's like that's why you want to just make sure they're number one in the space, or they're at least the top three. In some cases, I just say number one. If you're number one, you usually stay number one for a while. But the next thing, let's move on, is dividend yield. So when I heard dividend yield, I thought it was just a percentage of money that you get back from whatever it is that you get paid. And I thought dividend was like the percentage they get from dividing how many shares you own by their percentage of how much they pay you, and that it was not right at all. What it actually means is like how much cash the company pays you each year just for owning the stock as a percentage of the stock price. So I thought it was like, hey, if I got 10 shares, I get 4% of each share that I own. But it's similar to that. But a good example is like if a stock costs $100 and pays a 4% dividend yield, you get $4 per share every year just for holding it. And that's passive income. So when you hear people say, I invest to get dividends, or if you say, I want to invest to get dividends, that's how you make money. I was very wrong in my first experience, but yeah. So these are other things to look at when you're looking at stocks, because not all stocks pay dividends, but some do. But you care about this because, one, we're trying to be educated. Two is if you want companies that pay you to own them, you need to look for dividend yields. What's a good number for dividend yields? Anywhere from 3 to 5% is pretty solid. But I mean, if it pays more, really look into the company because they can always change how much dividends they pay. But it's a good rule of thumb to go by. I don't always invest for dividends. I really don't invest for dividends. It's more like I invest in the best companies and I want their stock appreciation to go up. So that's what I bank on. But some of the companies I do invest in, like the Microsoft, Nvidia, TSM, Broadcom. I think Broadcom. I believe Broadcom does a dividend, but I know for sure the others that I listed, they do have dividends. And of course, that's wonderful, but I usually have them reinvested. That's another cool thing too, is you can actually take the dividends that they're paying you and have them reinvested into the stock so you can build a bigger position in that stock. And then eventually you can just say, hey, I don't want you guys to reinvest the dividends. I just want to keep them. Because let's say you have 100 shares and you're getting $4 per share. It's like, well, you're getting $400, and then so on and so forth every year. So that's just passive income that you get just for literally just from owning it. That's pretty awesome. Yeah. So number 4, and this is a big one for me, is the ETF. It's an exchange traded fund. I think we talked about this a little bit before, but yeah, when I first thought of an exchange traded fund, I thought it was people with a lot of money and it was only they were allowed to trade it. But actually, it's just essentially a basket of great stocks. It's a basket of stocks that you can buy all at once for one whole price. It's like buying an entire grocery store instead of just singular groceries in an aisle. And a real example of this is SPY. It's an ETF. It's the S&P 500. It's 500 biggest companies in the United States. One share, you get instant diversification. So you are going to be invested in the 500 best stocks in the stock market if you were to go get SPY today. And one of my favorite things for this is for my risk averse people, or for my people who just kind of want to set and forget. ETFs are really good because they have an amalgamation of great stocks, best performing stocks, by the way, and they're managed by a fund or an exchange that automatically reallocates based off of market conditions. So S&P 500, for example, SPY, stocks can get added or removed from it. So a good example would be SanDisk. SanDisk was $50 earlier this year. They started doing really well. They had, I believe it was like a 400% increase, and now they're almost $300 a share, and they got added to the S&P 500 for one of the best companies. Now, when some companies get added, that doesn't mean others get kicked out, but most of the time they do get kicked out. So like a company that's not performing well, they get kicked out or they get moved down for you, so you don't have to do anything about it. You can just keep putting money in every month or whenever you want to, and those funds will manage that kind of stress for you. And it's not as dangerous as individual stocks. Individual stocks can go to zero, but ETFs, they move stocks out once they start underperforming. So you're a little more protected than individual stocks. So why do we care about ETFs? It's just an easier way of picking stocks rather than picking individual ones. You lower your risk because you're spread across multiple different things. So for my people who are like, I don't know what to invest in, I just want to kind of set and forget, and I still want to, invest my money and, make a living in the future and have some assets for myself. ETFs might be the thing for you because they're a basket of stocks. They make it super easy to invest. They have different ETFs for different sectors. They have them for different sectors, different themes. A good one that I look at is SMH. SMH is a semiconductor stock. It's a semiconductor ETF. So it has all the biggest semiconductor companies in one basket. The S&P 500, 500 companies in a basket, 500 of the best performing companies in a basket. And then there's healthcare like XLV, all the best performing healthcare companies. And there's XLC, communications. And then there's materials, there's energy, there's utilities. There's so many different brands and different places you can go. And there's the Spider Select ETFs, and then there's the Van Eck ETFs, and there's so many different ones you can look into. and we'll chat a little more about which ones that I personally look at once we go over my portfolio, maybe in the next episode or so on. But yeah, if you have any questions about ETFs, feel free to comment down below. Feel free to shoot me an email, shoot me a message. All that stuff is in the show notes, so just feel free to ask me any questions. And last but not least, number 5 is expense ratio. This was one, before I tell you what expense ratio is, I'm going to tell you a little story about my friend Brandon. He actually works with a brokerage. I'm not going to say his brokerage, but he works with the brokerage. And he was helping me go over my retirement stuff that is in my 403b plan for my job. And he was like, none of this money is invested. So why is it just sitting here in cash? I said, well, I thought when you have a 403b, you didn't have to do anything. He said, no, let me show you how to do it. And we go through these different allocation things and set stuff up. And we get to a point where he's like, this is one that tracks the S&P 500. I'm not telling you to invest in it, but this is something good because you can't touch this money for about 50 more years. So, you might as well have it growing for you at a faster rate in the meantime. And he said, pick this one. I would pick this one because the expense ratio tied along with what this specific thing tracks, because I have TIAA, so it's not the same as like opening a Fidelity account. It's like they have like CREF equity. So I don't want to get into the details of it. It's complicated, but so I didn't understand what was going on. But now I do. And he was like, this is just something that tracks the S&P 500 and the expense ratio is lower. So you're gonna keep more of the money that you're making. So let's get into it. What I thought expense ratio meant, I had no idea. I just thought I heard expense. I was like, well, that means it costs something. But I mean, it's like everything costs something. So I was like, well, I don't know. So I had no clue what it was. But what it actually means is it's the fee you pay each year that you own an ETF or mutual fund. So, example, a 0.03% expense ratio means that you pay $3 per year for every $10,000 invested. Over 30 years, that difference is massive. This is why we pay attention to it. So that's why you care. You want low expense ratios. You want low fees. You keep more of your money and you look for expense ratios under 0.2%. And this is what he explained to me. He said, when you're paying high expense ratios, you're giving away most of your money just because you want someone to manage it for you. ETFs are good to have, not something that I recommend you stay away from. I love ETFs. I actively invest, but pay attention to those expense ratios because that is going to tell you how much money you are spending per year over a long period of time. Because, I mean, $3 or $100 a year for 30 years, that's massive. So just pay attention to those things. So that's really all I got for you guys today. If you have any questions, if you have any comments, any thoughts, please feel free to reach out. All my information is in the show notes below. So I'll see y'all next time.